June 27th, 2024. Today was actually a pretty interesting day. You can see we had a bigger wedge, which is one of the reasons why I didn't like a lot of these sells over here, and I didn't really mark anything down here. It's because it's really important to look at wedges, and I know it doesn't look like a traditional wedge like you would generally see, but if it's three pushes down, the forces in the market are still going to be acting the same as a traditional wedge would be. Bar one, a bull bar closing near its high. It's good for the bulls. We're probably going to trigger above yesterday's high. If you look at the daily chart, you can see this hasn't been, overly exceptional follow through for the IOI from yesterday. So we'll probably end up triggering above this high, the June 26th high coming into the day. You should be expecting that, but you're not sure how much farther above we're going to go. The reality is if we get up to this close, the bulls who bought this high close and saw this are disappointed, and they haven't quite had a chance to get out. So most likely, I think once we touch this high close, the price is 55.62.75. There will probably be some sort of sellers, and the market will start to go sideways. We might push to the new all-time high, but I would not be surprised if we ended up finding sellers there for the same reasons. Disappointed bulls that I highlight a lot on the 5-minute chart. Bar two, consecutive bull bars. It's good for the bulls. We're probably going higher, but you have to keep in mind bar two is an awfully large bar. So it's a bit climactic, and when bars get climactic, it's more of trading range behavior than trend behavior. If you want a bull trend from the open, bull trends in general, what you want is relatively uniform bars. You want the bars, you can see it's the start of the trend. We're getting bars that are relatively the same size, 31, 32, 33, this bar, this bar, this bar, and then a big climactic bar, and we start to go sideways, right? So this bar, while it is good for the bulls, and we do have consecutive bull bars, and we are always in long, it's important to note that bar two is really climactic because of the size of the bar. So we might start to go more sideways. So whenever you see climactic bars, you should be thinking trading range. And just in general, 80% chance that there's a trading range open on any given day. So probably, 80% chance trading range open, but I think the more specific and useful stat is 80% chance of a minor reversal lasting at least 5 bars on the open. So you have to be asking yourself, does this look like it's setting up to be part of the 20%? And I would say with the tail on top of 1 and the overly large size of 2, it's probably not. Bar 3, an inside bar. Inside bars are high ones, but it's not a very good high one. Again, for the bulls, they want 1 and 2 to be the start of a bull trend. And generally you want a third bar. Consecutive bull bars is good, but you generally want 3. Three bull bars is so much stronger than 2. A lot of times you'll get a pair of bars looking like that, and then it'll end up just starting to go sideways and get disappointing. But the times that you don't, and you end up getting that third bull bar, the market gets, in general, a lot stronger. I think that, if bar 3 looks like bar 2, while it's still really climactic, it's, a whole lot more bullish than just 1 and 2, and then disappointment on 3. So an inside bar, bar 3, a high one for the bulls. It overlaps with yesterday's high, which is important because the limit order bears who sold above yesterday's high were able to scale in higher and make money on their second entry while getting out around break even on their first entry. So important that limit order bears are making money. An outside down bar on bar 4. Bar 4, you can sell it. I would say, if you're selling it, you're betting on a bull trap 1 and 2, and you want bar 4 to be the potential high of the day. So I would say, 30 to 35% chance that bar 4 is the high of the day, maybe 35. I wanted to sell bar 4. I don't usually trade the first 6 bars as just a general rule for myself, but I was considering breaking that rule today if bar 4 was not a big outside bar. If it was smaller and closed somewhere in here, I was probably going to take the short. Instead, the bar got bigger than I wanted it to be. And if you think back to what I was saying about bar 2, the bar is bigger than you wanted it to be. Look at bar 4, the bar is bigger than you wanted it to be. So what does that mean? That means this is a trading range open. When you're getting bars that just consistently get a little bit too large and they'll have a little bit of problems, it's usually going to be some sort of trading range open. It's still reasonable to sell bar 4. There's no problem with it. But I think the thing is, if you're selling bar 4, your risk is now larger. But there's nothing wrong with selling 4 and sitting on your hands and just letting yourself get stopped out, I suppose. But the reality is, if you're selling bar 4 and when you're watching bar 5 form, you have big up bars 1 and 2. Now you're getting big down bar 4 and 5. And you know that there are going to be buyers below bar 1 since consecutive bull bars closing near their highs. There's going to be support down here. So again, while you can sit through this whole bar, it's really not the ideal thing to do. as you can see, traders, they got 10 points right here and they just scalped out. So traders got their 10 points selling below 4. They got it pretty quickly, literally within 5 minutes. And, less than that, a couple of minutes, probably 2 or 3. And then they scalped out thinking that, wow, well, that was a really quick and easy 10 points. And when you're in a probable trading range open, if you get a quick and easy 10 points, you should probably just take it. We're getting a rally up on the tail of bar 5 and a double bottom with that tail on bar 6. Bar 5 is not very good follow through for the bears. If you sold below 4 and you saw 5 forming, you were hoping it was going to close on or near its low. One of the things you can start to detect when you trade for a while is when bar 5 was really large and near its low, it was only like 2.5 minutes into the bar, something along those lines. So the market still has 2 or 3 minutes left, and the bar is already humongous. So the question you have to ask yourself is the bar going to get a lot bigger? And the answer is probably not. What's most likely going to happen is it's either going to stay down here and close near its low, or it's going to get bought up. And so what a lot of limit order bulls will do, if you're 2 or 3 minutes into the bar and they see it's down here and the bar is already huge, and additionally bears just got 10 points and there's going to be support below the bar 1 low where bulls are buying, a lot of limit order bulls will just buy the market figuring, well, worst case it goes down, most likely worst case, obviously occasionally crashes happen, but most likely worst case, the market closes basically near its low and I lose like a point or so. And best case scenario, we get a pretty solid bounce, which is honestly probably the most likely scenario, that we get a pretty solid bounce and those traders are going to be able to make a scalp. And that's exactly what happened on bar 5. Double bottom with 5 on bar 6. Do you buy above 6? I personally would not. I think you're buying too high in a trading range. It's really difficult to take that kind of buy because we might have to test up a little bit higher, but with the size of bar 5, I think that it's pretty clear: big up 1, 2, big down 4, 5, and we're in a confusing area. So I don't really love buying above 6 because I see it as the middle of a trading range. Is it wrong? Probably not wrong to buy above 6, but I would not personally do it. And when I used to take the kind of trade like buying above 6, I would also probably exit below 7, which is really not a good thing to do. Doji bar 7, we're probably testing back up to at least the bar 6 high, since the traders who bought the bar 6 high did a reasonable thing, and they should be able to scale in and make money. So you would expect that we're going to get back up to there. Look where the bar 8 low tested to, essentially to the bar 6 close or bar 5 close. Why? Well, some traders will see this and they'll think, well, maybe it's still early in a bear trend and we're going to get a big second leg down because this whole thing was pretty strong and this big tail was at one point a big bear bar. So it's possible from 4 and 5 we get a second leg down. They figure if we don't get a second leg down, they can scale in higher and make money. So that's what they do. They scale in higher, maybe around the 3 low. The limit order bulls who bought below the 3 low are obviously disappointed, and they're going to be selling out of their longs. So maybe they sell to close, they sell more up here, and then they use the tail on bar 9 to exit, to buy back their shorts, and that's causing this rally on 8. 8, a doji bar, it's a double bottom with 6. It's a higher low double bottom, which is good for the bulls. We haven't had a close below the moving average yet today, which again, good for the bulls. But I'm not really too convinced that we're going too much higher. I think that I'm just to me this screams trading range open. So unless I can feel confident that I've seen the higher the low of the day with a trade, I'm probably just going to wait. Or I want to sell a small bar near the top of the trading range, or I want to buy a small bar near the bottom of the trading range. Bar 9, a huge bull bar closing near its high, yes, but does not break out of the high of bar 4. And this is your first leg up. 6, pull back, second leg up. This is a second leg trap. This is like a prime, perfect example of a second leg trap where you get the huge bull bar and the traders buying up here are thinking, wow, if we get one more good bull bar, this is going to be a big bull trend. But the reality is you're almost never going to get that big bull bar and you're going to end up disappointed far more often. It makes a lot more sense to just wait to see if you get another bull bar. And additionally, look at your signal bar on 8. 8 was not a good signal bar. And usually big bull trends have good signal bars. So when you get a disappointing signal bar like 8, the follow through on 9 is probably not exactly what you were hoping for. 10, a bear bar closing near its low. It's a possible high of the day. You could argue it's a wedge. 1, 2, 3. I think it's credible to sell 10, but you have to be realistic about your expectations of the trade. You know that you're going to get a second leg sideways to down because 10 is a really strong bar. But you also know that 9 is a really strong bar, so you're going to get a second leg up from 9 most likely. So if you're selling below 10, you probably are not going to just collapse straight down. You know that. So it's probably reasonable to sell below 10, put a stop above, and go for twice your risk, which, I guess it got within one tick of that. But that, there's a reason why their traders were buying back shorts down here. And it's because it's around twice the risk. It's better than twice the true risk. So that would be twice your true risk. And you can see we ended up getting into that area. But again, if you're selling below 10, you have to think about how strong 9 is. The bears still have not had a close below the moving average yet today. And the bulls are getting reasonably strong closes with bars 1 and 2 and 9. So again, reasonable to sell below 10, but you can't be surprised when you see 11. That's kind of what you're signing up for. 11, disappointing follow through, but expected. We might have to try to rally back up to the bar 9 close. It's essentially, what do the bulls want? Well, the bulls want this, 10 to be a bear trap and for the bull trend to resume. And, more likely we're just going to end up going sideways. What it really was bar 9 was a spike, and bar 10, could have been the pullback. And then this ends up being the channel up. I know it doesn't look like it, but 11, 12, 13, and 14 is a bull channel. And let's look at like the 2-minute chart or something. So it's a bull channel. It's not a good bull channel, but it is a bull channel. Maybe it'll even be clearer on a 1-minute chart. So you can see, so high, higher high, higher high, low, or higher low, higher low, higher low. So it is a bull channel. It's not a good bull channel, but how do I know it's a bull channel? Well, if you look at it, you can see all the pullbacks in the high of bar 11, the high of bar 12, the big tails on 11 and 12, and the tails on 13 and 14. Those are all pullbacks. They're not just, so you should be thinking of tails as they're lower time frame pullbacks. So it means that this is not as strong of a move up as it could be. So 12, a bull bar, it's, quote unquote follow through for 11. I just think it's the channel and it looks like a pullback. We're probably going to get a second leg down. You can see there were buyers below 12. It's a bull bar. It's a bad low one short. It's probably okay to buy below 12, but I personally would not, because I think you're buying high in the tight trading range. I think it's better to look to buy below bar or to sell above bars when you're this high in the range. So again, bull bar, it's not a good sell below 12, but I'm not personally sure I would take the buy because I think that we're relatively high in the trading range. But I could be wrong about that since I don't trade limit orders. 13, a reversal up. The bull bar closing near its high. Not worth buying to me. It looks like a second leg up. 11, 12, pull back during 13 and reversal up 13. 14, follow through, but basically just a doji bar. Big tail 13, big tail 14. You do not want to see this large of pullbacks. If you're buying up here, you're hoping we're going to get a dramatic breakout to the upside like bar 9, and you're going to make it quick, 5-10 points. It's probably just not going to happen. So to me, it looks like if you can think about it, as the spike, and then this is the pullback, this is the channel. You can think of it as, this is how I thought of it today. Bar 10, possible low or possible high of the day, but again, we might have to test back up a little bit. And leg 1, and then we pulled back below 12 and started the second leg up. So it was a 1 pullback 2. So second leg trap almost, bar 14, 13 and 14, and then reversal down 15. Why reversal down 15? Because look where it tested. It tested the close of bar 9. If you bought the close of 9, if any of you did that, how did you feel when you saw 10? Probably weren't very happy with how that went. So then you get the 2-legged reversal up. The bulls who bought here and scaled in lower, they are using the reversal up on 15 to get out of their longs because they were very unhappy with how the trade had gone. They were hoping to get basically the opposite of bar 9, the opposite of bar 10, a big bull bar closing near its high. Instead, they got that. 15, head and shoulders top, 4, 10, 15. It's still credible to say that 10 was the high of the day. So it's a reasonable short below 15, but I would not take it because of how big the tail is. And you are still following 4 straight bull bars. It's I don't have a problem, or there's nothing like inherently wrong with selling it. I think it's okay, but I think that, you have to have a very good understanding of context if you're going to take that kind of trade. So I would rather just wait for a bear bar closing near its low, which you do get on 16. Follow through on 16, we have consecutive bear bars. I think a lot of bears are looking to sell some sort of pullback, but it might not end up coming, which is often the case. If you find that you're sitting there waiting for a pullback, it means that the pullback might not end up happening because most traders are waiting for a pullback. And when most traders are waiting for a pullback, sometimes what they'll do is sell a small position at the market just to establish some sort of short. And then if the market pulls back and they end up getting the lower high they were looking for, then they can sell more. But traders trying not to get trapped out will sometimes just sell a position at the market. 17, follow through for the bears. So 3 consecutive bear bars. That it's strong enough. It's first leg down in probable trading range. We're probably going to get a second leg down. but you are selling in the middle of the trading range at this point. You know we're probably going to get a pullback. The tail on 17 or 16 and 17 is not all that encouraging, but no tail on top of 16, meaning traders immediately sold when it opened, which is important for the bears and reasonably strong. Reversal up 18, but it's not that good. Bulls hoping this is a bear trap and they're going to get a big reversal up, but it's closing right on the moving average. Or you can see we touched the moving average and failed, which is really important. When you can't get above the moving average and the market keeps failing at it, that is a very big signal that it might not. When the market keeps touching the moving average and failing, that's a clear sign that the bears are winning, and that even if the bulls keep getting reversals, if one of them can't get above the moving average soon, the bulls are going to end up giving up. 19, a bear bar with a reasonably strong close. You can sell below 19. You're hoping that you're going to get really good follow through if you do. 20 is follow through, but it's really not very good. You can see a tail on the top and the tail on the bottom. So I don't know. I think I would probably just rather wait at this point. It's okay to be short. I don't know. So I missed this whole thing. This move, I did not trade it. It's okay to be short, but I think if you sold below 19, you're hoping for a bar like 16 or something, some sort of really good follow through. You know that there's a 90% chance on any given day that we're going to break out of the 18 bar range. And at this point, it's a bit more likely we're going to break out to the downside than the upside. So it is okay to hold short through all of this, but it's really just, it's a bit, it's not as ideal as it could be, is what I guess I'm saying. You want to see good follow through, and then you get more disappointment. 21, an inside bar, basically just a doji. So really not all that ideal. I think that probably going to go sideways soon. And if you sold below 19 and you saw 20 and 21, traders know that this is kind of a dangerous spot, and sometimes it's going to get bought up pretty quickly. And so what they'll do is just buy back shorts at the market, and that's what's causing the bounce on 22. Sometimes this bounce will get a lot bigger, but here it was just a small one. And you can see traders instead, we ended up selling off a little bit more. 23, you can see there were buyers below 22 initially, but you're buying in a bear trend, so not a very good idea. Note 15, 16, 17 is spike, 18 pullback, and channel down. When you get, I don't know, there's probably some sort of measured move baked in here somewhere, I'm sure. Something like that, maybe. I don't know. But the point being, when you, one more try. Hold on, sorry. I just like messing around with these. Yeah, somewhere in that area. But I lost my train of thought. When you get spike pullback channels. So first off, 21 and 22, consecutive inside bars. So an II pattern, 21, 22, and II patterns are generally final flags. So if we have a final flag, you should realize we're probably going to end up coming back to that final flag at some point later today. And when you have a spike, pullback, and then channel, you know that the top of the channel is going to be a magnet. In a way, you could think of it as the top of the channel is where the trading range is starting, and it's a target for the trading range later. So the spike, the pullback, the channel, yes, bearish, yes, always in short, yes, but theoretically could think of it as the start of the trading range, knowing that this is going to be the top, so it's likely that we're going to test back up into this area. 23, I think I talked about 23, but not really all that great. Outside down 24, surprise, big tail on the bottom. Again, this is not all that ideal. I think it's okay if you missed out on this this move down. 25, follow through for the bears, but a big tail on the bottom. So yeah, it could be some sort of wedge. 11, 17, 25, something like that. Or, maybe even steeper, 12, 17, 25, maybe something like that. And then reversal up 26, a bull bar closing, not quite near its high, but closing relatively decent. I think it's okay to buy above 26. It's a small bull bar near the bottom of a forming trading range. How do you know this is the trading range? Just look at how strong these bull bars have been. This would be really unlike a bear trend day. And where are the really strong consecutive bear bars closing near their lows? We don't really have them. So to me, this looks like a leg in a trading range. But if you're buying above 26, what do you have to realize? Well, it's still a tight channel down. So what you do is you buy above 26, you buy small, put a stop and measured move down, maybe plus a tick or two, somewhere in this area. And then you add on when we go below 26 during 27. So 26, a bull bar closing near its high. You have protection in the fact that you know that 26 was a really strong bull bar, and we're probably going to test back to its high. Additionally, there's something else that's important. Even though it was not good to buy up here, it was still 4 consecutive bull bars. So there are bullish algorithms that will buy this close and scale in all the way down. And the traders that are doing that, or the algorithms that are doing that, as a trader, you should never do that. But the algorithms that are doing that know that if they bought above 14 and they look for the next bull bar closing near its high to buy above that, 80% chance it's going to reach the midpoint. And so this is your midpoint. And I don't know if it's exactly 80% buying above here that's going to get here, but it's probably better than 60, I would say. So really good math to buy above, I think, 26 for the stop and measure move down. You can scale in below. Outside down 27, really not very good. Triggers the low one below 26. And 28 was a really interesting bar. Once 28 closes, you can put your stop below 27. Like I said, the point of having a stop and measure move down is to allow one reversal against you. So that's what you want to do. Is you don't know what the reversal down is going to look like, right? So you know that you can see you get a reversal down here. You can do the same thing over here, and the reversal down looks a little different. But again, the point is to allow one reversal against you and then for the market to go in your direction. That one reversal against you could be looked at as, the final leg of that sort of move. So if you have this big bear move, this is, 27 is essentially the final leg of that because the bears needed one more leg down after how strong the move down was. 28 was a bull bar closing near its high. You can buy above 28, hoping again to get to that midpoint. And 28 did something really interesting. About 30 seconds left in the bar, 28 was somewhere down here. And I was thinking to myself, 28 should not, if this is going to go up, 28 should close a lot higher. Why? Because there's no way that the bulls who buy above 26 with less information should get a worse fill than the bulls buying above 28 with more information. So time is money in the stock market. And the more time that you take to enter the trade, the less money should be available to the people doing that. So if the bar closed down here, it gives traders a better chance to get in with more information at a better price. That's suspicious. When that happens, a lot of times the market is not going to go in your direction. The market should not, if you don't take an entry and you're really hesitating and you think it's a good entry and then it goes against you and offers you another signal, like this, if 28 had closed somewhere down here, a lot of times that signal bar will end up failing because it just should not be offering you that better price, and traders get very suspicious of that. So 28, an inside bar, it's an IOI pattern, 26, 27, 28. I actually didn't notice that till right now. I was just thinking about it a different way, but it's still an IOI pattern, breakout mode pattern. Okay, strong buy above 28. Disappointing follow through 29, but we did trigger above 28. I think that 28 is a big enough, strong enough bar that those traders should be able to make 5 points. So disappointment 29, but I still, the premise is still valid. We're low in a trading range. We're probably going to rally, so you can't really let 29 change your ideas. 30, a bull bar, but a big tail on the top. We're probably going higher. How much higher? I'm not totally sure exactly how much higher, but we are probably going higher. Like I said, the top of bar 18 is the top of the channel. That's a target, the 50%. It's funny because we did actually basically rally straight up to that midpoint before stopping. You can see bar 36 high is exactly that midpoint. So it was clear the market was paying attention to it. 31, follow through for the bulls, but a tail on the top. Still reasonable to be long. Okay, okay to buy the close. Follow through 32, closing above the moving average. Good for the bulls. We're probably going at least a little higher. We keep getting these little micro gaps down. So the close of 30, traders sold the close. We got a gap down. 31, they sold the close. 32, they sold the close. Which is, that happens sometimes, but it's far more important. The gap is far less important than the fact that bar 32 closed above the moving average. That was really good for the bulls. More follow through on 33 with most of the body being above the moving average. So we are probably going at least a little bit higher. But now we're starting to get into the middle of the trading range. And the middle of the trading range is always a profit taking zone. So to me, it's better to just be, more neutral in this area and try to get back to flat at a good price. You can see traders who bought above here needed to get 5.5 points to make 5 points. You can see they did during bar 34. I thought it was exactly 5 when I saw it earlier. I'm not sure why. You can see they were able to make 5 points, and it's a doji bar. Probably buyers not too far below, considering how tightly up this channel is. But it's a trading range, so pullbacks can be deeper than expected. So traders instead, they buy the close. We get the rally up on 35. But 35 is a climactic bar. I think 35 is more of an exit your longs, sell the close kind of bar. Not actually sell the close, but sell out of longs kind of bar than it is to buy more above. And you get disappointing follow through 36. An inside bar 37, an inside bar 38. To me, this is a final flag, so we could break out above it or below it, but I think we're going to start to oscillate around this area. We're probably around the midpoint of the day. You can see we were exactly at the midpoint of the day. And the open of the day is always important on trading range days. So, you have to keep in mind that the open of the day is always going to be a magnet when it's a trading range day, and you oftentimes get a late test up to it, especially on a day like today when on the daily chart, the bulls are trying to prove something. They're trying to prove that their IOI pattern is going to be a successful breakout. Bears would have really liked to have put a bear close on the day, and they were not able to do so. 39, a reversal up, but not worth buying. I think it's just a failed breakout below the final flag. The breakout above will probably fail as well. 40, a reversal down, but midday reversal, yeah, but this is not worth doing anything. I think we were in the middle of a trading range. You need to wait for a breakout. 41, you can see we traded above it. And again, better to sell above bars in the tight trading range, fade the top of the trading range than it is to buy, than it is to sell lower in it. 42, a big bear bar closing near its low, but again, possible wedge, 36, 39, 42. I don't know if I would sell that if it triggered, but it didn't end up triggering. You can see instead bulls bought the close and we got the big rally up 43. So big up, big down, 42, 43, expanding triangle, 36, 39, 42 on the low side and 36, 40, and I guess 43 on the upside, but it ended up being 44, but you can see expanding triangle. So not good buy above 44. Doji disappointment bar 45. We're just going sideways at this point. It's better to do nothing and just wait for a breakout. I think I just said 44 instead of, I said 45 on accident, but 45, still doji bar, basically not really worth doing anything. There's probably going to be buyers down around the 41 low if we get there. You can see the traders who sold the close of 42 trying to front run the breakout down. We're disappointed, but if they scaled in above the bar, this is why you can't sell the close of 42 and put a stop up here, because the market will always in trading ranges will run these skunk stops. But if you sold the close of 42, scaled in higher, these traders use 46 to buy back their shorts, and that's what causes the big bounce 47. Can you buy 47? Yeah, it's a big enough bull surprise you can buy it, but I don't think we're breaking out to the upside of the 18 bar range. We've had too many times this week. It's Thursday, and I think like twice this week we've broken out to the downside and then to the upside of the 18 bar range. So I didn't really think we were going to do it again. It'd be pretty rare if we kept doing it that much. That's not a very common thing to happen. Normally, if it happens once, on Monday, this is interesting. Sorry, not Monday, Tuesday. So on Tuesday, you can see, well, what did we do on Monday? Okay, just with the one breakout. But Tuesday, this is the 18 bar range. We broke out to the upside, the downside, and then back to the upside. It's really rare for the market to do that, to break out of the 18 bar range 3 separate times. Wednesday, we had 2 breakouts. We had the downside breakout and then the upside breakout of the 18 bar range, which is still pretty rare. So we had 3 breakouts of the 18 bar range, then 2 breakouts of the 18 bar range. I did not think we were going to have another day with 2 breakouts of the 18 bar range. I thought just with how much that had happened this week and how it's not a very common pattern, it was less likely that it was going to happen than normal. And I thought we were most likely going to go sideways to down. Additionally, we have a lower low. So this and then that. So we have the lower low 27. It was a big bear channel day, right? So we're probably going to form a lower high from this. It's a pretty strong channel, so it usually is going to get a lower high. 48 consecutive bull bars closing their highs, but I don't know if it's all that good. Probably better to buy below 48 like they did instead of above it. 49, you can see there were buyers below 48. 49 is a high one for the bulls, but really not that good since bear bar. 50, an inside bar, a high one. So ledges are generally 4 bars with the exact same top. Here it was 3 bars, but a lot of times it's close enough with this kind of pattern. What it means is, like 90% chance that we're going to get a breakout above, and then it's going to fail and come back below the ledge within like 100 bars. It's not the most useful stat in the world, but it's pretty cool. And you can see we got the reverse. We got a breakout above and a failure, and then we ended up getting back to that price later today. So the ledge is always an important magnet. Additionally, bar 50 close. We never tested the bar 50 close on this sell-off, so it made sense for us to try and get back up to this area. I didn't think we would when we were down here. I thought that the magnet was going to be the top of the channel because this is. Well, I'll get to that in a second. Hold on. So it's an IOI pattern to 51 or to 52. I think it was on 50. Yeah, I was on 50. Okay, high 150, not a good buy though. You're buying really high, and this is clearly resistance, and we're probably not getting all the way up here. I'm not taking that. I'd rather trade the reversal 51, but does not close near its low. Still probably okay, even though it didn't close near its low, but you can see it never triggered. And then 52, bulls tried to buy the market back up to the bar 50 close, but failed. It's an IOI pattern. So we've had an IOI reversal here, IOI reversal here, formed on the daily chart. We're getting a lot of these recently. And you can see, so reasonable to take a chance. We're getting at the break to the downside and sell below 51 during 53. 53, initially buyers with moving average, not as good as it could be. Looks like it might go more sideways, but a bit of an edge for the bears here because looks like it's forming a bull flag. Or sorry, this looks like a bear flag to me. And then 54. Why does it look like a bear flag, by the way? Because this is not a strong bull trend. Go look at examples. Go look at strong bull trend days. They don't start like this. And so this looks like a leg in a trading range, therefore a bear flag. 54, a bear bar closing near its low. You'd sell the close, reasonable to sell below 54. And then you get 55. And 55, again, trading range bar, right? It's the same thing as over here. 55 tells me that we're probably in a trading range and we're probably not going all that much lower. And a lot of the bears, they sold below 54 and they weren't even able to get 10 points, but you can see they just started taking profits because of how big the bar was. 56, an inside bar, high one for the bulls, and the bears is a low one, but I think this is just going to be sideways. I'd rather buy a reversal up from lower or sell a reversal down from higher. 57, an inside pattern. You can sell 57 taking a chance that we just crash, but I don't think it's all that great and it's not all that likely. I would just rather wait. You can see there was a lot of support in this area earlier, and we're back in this trading range area. So probably buyers somewhere in this area since we're towards the bottom of the trading range, which is the buy zone. We have the lower low, and the lower low, and the lower high, and the lower high. So we're probably going to put in one more low. So disappointment, 50, 58 for the bears who sold below 57. 59, you can see it's just a doji bar. It's really not all that great. So probably buyers not too far below, probably sellers not too far above. 60, a bear bar closing near its low, but it's just a bear bar at the bottom of a trading range. It's not very good. And then a strong reversal up 61. The thing about 61, the thing is when you're in the buy zone, so down here, right? It's a bear channel, but it's really a trading range because the bulls have been making money all day. It's a really weak bear channel, and weak bear channels are usually bull flags. So when you get a good looking reversal up 61 from the bottom of the channel, at the very least, we're probably going to test back to the 61 high if we pull back. We are probably going to pull back because the sell-off to the downside was relatively strong. But again, same thing with 26. If you buy above 61 and put a stop, a measured move down, you're probably going to be fine. You're very likely going to make money. And you get a disappointing bar 62, but 61 is strong enough that it's going to get a second leg sideways to up. So 62 is really a terrible sell. You're selling a wedge 1, 2, 3 at the bottom of the trading range, so it's really not very good. And right after 61, traders know we're probably going back up there, so it's really bad. And again, if you do sell 62 and you see 63, you have to exit at the market. If you sold 62, you have to think about your premise. You're taking a low probability trade, and it's a reasonably big bar, so reasonably big risk at the bottom of a trading range. It's not what you want to be doing. If you're taking it, you need the follow-through bar to be really dramatic. You need something like bar 10, just running all bull stops and surprising everybody. Instead, you get what you're probably going to get, a disappointing bar. And so those traders exit the market causing 64. Why else was I not surprised, right? To see 64. 64 is a surprise, but it's not all that surprising for two reasons. If you look, the open of the day is this low. The low is 5538.5, and the high of bar 57 is that exact same price. Why is that price important? Because it's the start of the channel. So it's the spike, 54, 55. You could say 53, 54, 55, but I would say more 54, 55. And then the pullback, 56, and then the channel down, 57, 58 through 63. So the top of the channel, like I was saying over here, the top of the channel is going to be a magnet. And so I was expecting us to get back to the top of the channel since it was also around the open of the day. So that's going to be a really important price. I think I'm wrong, actually. I might be off by a tick. Yeah, okay, it's one tick higher. The open of the day is one tick higher. Sorry. But it doesn't matter. It's the same thing. It's still the same price. There's going to be a lot of traders looking to exit their trades in this area. So that's why it's not surprising to get the big bull bar 65 or 64. Some follow through 65, but you can see the target basically got reached and traders started scalping out. We closed below the moving average, disappointing. Some follow through 66, but again, disappointing. And then 67, a bull bar. But again, none of this is all that excellent anymore. An outside bar 68, and then a bull bar closing near its high 69. I would probably just be done for the day at this point. We're probably just going to go sideways. I would leave, you're never going to predict this. Just leave it alone. But basically, you could argue wedge 1, 2, 3. It was a wedge channel. You should get 2 legs sideways to down. And you can see 75. Some traders will sell it. And then once we get here, though, the risk is really large. So traders end up exiting and you get a huge surprise back up to this point. You can see what's happening here is traders are fighting over the close of the day. The bulls really wanted to see a bull close because they wanted more follow through on the daily chart. And obviously the bears wanted to see a bear close so they can say that the bulls were not able to get follow through on the daily chart. So big broad bear channel day and a big wedge. For stop orders, four is good. I thought 10 is reasonable, but you probably just have to sit through 11, 12, 13, and 14, to be honest. Um, I thought 19 was the best. I mean, 15 is probably okay, but it's not my trade at all. I think maybe 19, but probably not my trade either. 26 makes a lot of sense. 28 makes a lot of sense. And probably buy the close 31, 32, 33. Um, but getting tough 33, getting towards the profit taking area more so than anything. So it's probably scalp. Tight trading range, maybe 47, but I don't think the context supports it. But a good looking bar. 54, you can sell the IOI below 51 if you wanted to, but 54 and then 61. But if you're taking 61, you are not exiting below 62. You hold on to that trade. Unless 63 is a bear bar closing near its low, you do not get out. 64, you could buy that. Probably, obviously more information. See how it's more information here, and you paid for that extra information with about a point profit. That's how it should look. And that's about it. Again, the best buy belows on the day, probably buyers below 26, probably buyers below 61. We weren't even able to trigger 61. The daily chart, I think I've already talked a lot about it, but it seems like we're forming a tight trading range in some sort of final flag. Tomorrow is the last day of the week, though, which is interesting. So the weekly chart seems to be forming an inside bar. Inside bars are high ones, so the bulls want a high one in the bull trend. But I don't know. This looks really overdone to me still. I still think we're gonna get a pullback. But again, the bulls did a really good job undoing this. This was really strong. To me, I saw this in a test of 5,000, and I thought, do I have a study there? No. I thought, trading range, but they're doing a pretty good job here of convincing people it's not. But I still think this is relatively due for a pullback. But if we keep getting bull trend days, I'll keep trading them like that. So you just kind of have to trade stupid sometimes. And it's near the end of the month. Like I said, bull's doing a really good job with this rally, consecutive bull bars. We had a 1 bar pullback, and we have this open gap. So good for the bulls. The bears, they want to try and use the last couple of days of the month. I think we have 2 trading days next week and tomorrow, so the last 3 days to put as big of a tail as possible on this bar. But they're gonna have to do something pretty spectacular. So to me, it looks like the bulls are gonna definitely win the month. And yeah,